In this video, we will look at Warner Bros. Discovery. The stock is down more than 40% from year to date, so we will look at the main reasons behind the recent drop in price. We will look at some of the numbers, and then we will update the fair value calculation using the management projections, and we will take the current price to estimate the potential upside. So let's get started. First of all, if you want to get updates about Warner Bros. Discovery, you can subscribe to the channel by pressing the subscribe button under the video. You will not miss a single new video. Okay, if we look at the chart of Warner Bros. Discovery, we can see that the stock is down more than 40% from year to date, while the S&P 500 is down close to 20%. The stock is down even more than S&P 500. So what are the main reasons behind the drop? Right now, I'm reading lectures of Joel Greenblatt. Joel Greenblatt is an expert in spin-offs. He is the famous author of the Magic Formula book. He also is the founder of Value Investors Club. So he made a course on value investing and special situations. And during his lectures, there was a guest, Bruce Newberg. He talked about a stock, I believe it was called MIPS Technologies. Bruce Newberg thought about buying the stock. It was after the internet bubble. So the stock was down significantly. It was removed from the index, so the funds were selling the stock, and it was end of the year tax selling, so the stocks with the most decline was sold due to tax purposes, tax harvesting. So as he called it, it was triple witching hour. And I believe there are similarities with the current situation with Warner Bros. Discovery. So first we have negative market sentiment. Interest rates are rising, we have high inflation, more than 8%, we are almost in the bear territory. The S&P is down close to 20%, so that is the first reason. The second reason is the overall negative sentiment in the streaming industry. Recently I made a video on Disney. It was down from $200 to $95. Netflix was significantly down, so we can see a negative sentiment in the streaming industry. The streaming industry is viewed as very competitive, so it has a lot of competition. It has unpredictable free cash flow, so that free cash flow is discounted a lot. So again, we can see a negative sentiment in the streaming industry. So that is the second reason. And the third reason is the sell-off pressure from the owners of AT&T. Right after receiving the spin-off Warner Bros. Discovery, they started selling the stock. So we can see a sell-off pressure. They are only for the dividend, for the passive income. They are not interested in the streaming stock. So that is the third reason. So just like in the example that I made, we can see three main reasons for the stock decline. Which brings us to the next point. Has the story changed? Does it change the valuation? So right now we will update our valuation and see what kind of upside Warner Bros. Discovery offers from the current price. Management is projecting for the EBITDA in 2023 to be 14 billion. I took 15.5 billion. Why? Because management is projected for cost synergies between Discovery Communications and Warner Media up to 3 billion. I took half of that to be on the conservative side. So we will use the EBITDA of 15.5 billion. We will use the leverage of 2.75 of the EBITDA, which is in the middle range of what management is projecting. We are using the free cash flow conversion of 60%. In our calculations, we will use the EV to EBITDA estimates of 10, which is on the conservative side. Disney and Netflix traded at much higher multiples, so 10 is on the conservative side. So we get the enterprise value, we subtract debt, add back cash, we get the market cap, we divide by the number of shares outstanding, and we get the fair value of the stock, in the conservative scenario, of $48.5 per share. This implies 246% upside from the current price. Also, if we take the current market cap of 34.5 billion, we get the free cash flow yield of 27%. So according to management, if Warner Bros. Discovery makes 15.5 billion of EBITDA in 2023, they will have a 27% free cash flow yield. We also can see that they have close to 42 billion in debt. I believe actually they have even lower debt, but if they have debt of 42 billion, which I believe is on the conservative side, it is very likely that they have much lower debt. If they have free cash flow of 9 billion, they can repay the debt in 4 to 5 years. So if they have close to 9 billion of free cash flow, debt not seems to be an issue. So these projections were confirmed by management in the recent conference call. So in 1 year, if they manage to make close to 15 billion of EBITDA, they will have close to 27% of free cash flow yield. So we can see a negative market sentiment, we can see a negative sentiment in the streaming industry, and we also can see a sell-off pressure from AT&T. But if we look at the management projections, which were confirmed on their conference call, on the recent conference call, we can see that if they are correct, we can expect a 27% free cash flow yield in 2023. So according to this valuation, Warner Bros. Discovery offers a huge upside potential. Also, if you prefer to have a dividend and a more defensive stock, here's the video about AT&T. If you are not subscribed to the channel, you can do this by pressing the subscribe button right here. You will not miss a single new video. Thank you very much for watching to the end, and see you in the next video.